This conference will now be recorded.
Good afternoon, everybody. This is Kathy Neifeld with Agency One. It is Wednesday, June 3rd, and I am pleased to present the continuation of our webinar series. Today, we are going to focus on a very unique product from Pacific Life. And if you're all looking at your screens, it's titled Ride the Wave to More Business. And we are confident that once you learn about the Pacific Life Promise product and opportunities within this product, you're going to be able to source more business, not just now during this pandemic, but obviously after the pandemic is over. I am pleased to have as our presenter today, Carlin Snipes, who is our field VP for Pacific Life. And also on the line, I have Ed Stark. As everybody knows, Ed is our Vice President of Case Design. So without further ado, I am going to turn it over to Carlin. One quick reminder, if you've got any questions, please type them into the chat box and we will address them at the end of the presentation. Carlin, the floor is yours.
Thank you so much. I appreciate you guys taking the time to join us today to learn more about some Pacific Life products and solutions. So what I want to focus on today is an opportunity, I think, for you in this environment that we're living through today, that is an opportunity for a fluidless underwriting process. I'm going to talk to you about that. And I'm also going to spend a little bit of time talking about some things that are a little bit different with our conversion policies I want to make sure that you're aware of. So as Kathy said, if you have any questions, please put them in the chat box and we'll address those as well. So we're going to start off with smooth sailing. So this is our Fluidless underwriting program. It is available on both our term policies as well as our GUL policies. Our term policy goes down to a minimum face amount of $50,000 and our GUL goes down to a minimum face amount of $25,000. The way this program works is the last three bullets on the left-hand side of your screen there. So it's available for clients who are the age 50 to 69. And we do use age nearest with this program. So if you have a client who's 69 and a half, we're going to consider them a 70-year-old and they wouldn't qualify for the program. But if you have a client who's 49 and a half, we'd consider them 50 and they would qualify for the program. So just keep that in mind. But there's not a lot of carriers out there in the marketplace that have an opportunity for you like this in this age range. So what we're doing is ages 50 to 69 for face amounts of up to $1 million, either applied for or in force with Pacific Life. And what I mean there is, let's say you have a client who has a $200,000 term policy with us today. They could come back and apply for up to $800,000, let's say GUL with us and qualify under smooth sailing if they meet the smooth sailing qualification requirements. So that's what I mean by applied for or in force with Pacific Life. And then the last requirement, I think, is the most important one. We require that the client actually had a comprehensive physical and blood work done by their primary care physician in the last 18 months. So those are the three requirements. It's a pretty simple program. Number one requirement is the client's age. Number two is the threshold of $1 million. And the third requirement is that they have to have gone to their doctor in the past 18 months and had blood work done. And when I say blood work, I don't care what kind of blood work it's done. It could be they're testing for lipids. Maybe they're diabetic and they're going on a regular basis to get their blood work checked. As long as a needle went into the client's arm and blood was withdrawn, that's what I'm looking for. So I'm not looking for an insurance panel, if you will, if we look at it that way. For this we do not use, so we're not going after a paramedical exam with this process. What we're doing is we're going after the client's APS to get the information that we need to underwrite the consumer. So we're not using credit scoring or black box scoring or LexisNexis to make an offer. So when we look at one of your clients, we're going to be able to tell you exactly why we made the offer that we did, because we're going to use traditional underwriting to make that offer. So I'll give you an example. Let's say you apply, it looks like the client's going to be a preferred risk. They go through the process and we come back and we say, unfortunately, they're standard. We'll be able to tell you why we said they were standard because we're using that APS. If you go to another carrier that has a similar program, what usually happens if they're using something like LexisNexis or credit scoring, they're not going to be able to tell you exactly why they made the offer that they did because it's a score that's coming up with that solution. You can access smooth sailing through our long application or through our drop ticket platform, which is available for both our term process and our GUL process. And the reason I bring that up is it actually gives you the opportunity from beginning to end to have a touchless process with your client. So they don't have to have someone coming to their house and taking blood. They don't have to worry about that, because if they qualify based on age and face amount and they've gone to see their doctor in the past 18 months and had blood work done, then we're not going to come and have a paramedical come to their house. We're just going to go after that APS. Now, other thing I'll point out to you before I leave this page is only about 10% of the people that qualify, or apply for smooth sailing don't qualify. And I'll tell you the primary reasons what happens to make them not qualify for smooth sailing. One, I had a client apply and they were 47 years old. Well, okay, they're not going to qualify for smooth sailing fluidless underwriting because they're not between the ages of 50 and 69. That's one thing that you can see happen. Second thing you can see happen, client comes in, applies for smooth sailing, applying for $1 million in face. During the underwriting process, they decide to increase the face amount to $1.5 million. We're not going to let them qualify anymore for smooth sailing because they've exceeded that $1 million threshold. So they would go back to our traditional underwriting process, which would require a paramedical exam. The last bullet on the page is where I see the most likely when someone's going to get kicked out. And usually what you see happening here is a client is just misremembering either timing or what happened during the visit. So what I've seen happen here is the client tells you, yep, I went to my doctor and I had blood work done. And they did, in fact, go to their doctor. They went to their doctor 2 years ago and had blood work done. So that means they're not going to qualify because they didn't meet that 18-month threshold. Or they say, yep, I went to my doctor. And in fact, they did go to their doctor. They went to their doctor 6 months ago. But unfortunately, they didn't have any blood work drawn while they were at their doctor. So that would make them not qualify. So those are the primary reasons that I've seen that 10% kick out that we have on this program. But other than that, if they meet these 3 requirements, they're going to qualify for smooth sailing. And I do see a question about backdating to save age. You can backdate to save age from a price standpoint. We won't allow you to backdate to save age to qualify for the smooth sailing underwriting program. A good question, and that is a good question. You can backdate, but you just can't backdate to qualify for the program. You could backdate to save age to save price, but not to qualify for smooth sailing. So as I mentioned on that slide, we do allow you to actually access the program either through our drop ticket platform or through a long application. Whichever way you'd like to do it is fine with us. I know a lot of folks right now are really focused on doing everything they can electronically to keep that touchless process. So what I wanted to show you on this page is if you actually utilize the drop ticket, this is what it's going to look like. So I'm just going to pull up a sample. And I just want to show you on this sample what will happen. Let me just scroll down a minute here. So what you're looking at here is what's going to pop out on our drop ticket platform. And these questions are going to pop out based on the information that you're providing. So if you indicated on this example, it's a $250,000 case and the client is 55 years old, let's say, that means based on those 2 things, they could potentially qualify for our smooth sailing underwriting program. So what's going to happen is the system is going to automatically ask you some additional questions that you wouldn't normally see if they didn't potentially qualify for smooth sailing. So the first of those questions that's going to pop out is this one right here. Has the proposed insured previously completed a lab and exam? Now, I will tell you, I kind of think this question is a little confusing or misleading because it doesn't come out and say, have they gone to their doctor in the past 18 months and had blood work done? So if you forget this process and you say no here, these other questions are not going to pop out. But do not worry, if that happens and you say no, what's going to happen when our fulfillment vendor calls your client to complete the part 1 on the phone, they're still going to ask the client smooth sailing questions because based on their age and based on the face amount, they could potentially qualify for our smooth sailing underwriting program. So they're still going to ask the questions regardless of the way you answer this. So I just want to point that out. But if you do say yes here to this question, yep, my client did complete a lab and exam, then the tool is going to ask you, was the lab and exam completed by another insurance carrier? And you can say no, because you know it was done by their primary care physician. And it's going to ask, how long ago was the lab and exam completed? And it's going to give you this drop-down box to choose from. And again, this is just triggering, this client could definitely qualify for smooth sailing based on the information provided in the ticket. So that's what's going to happen there. Now let me go back to the PowerPoint. This is a sample of our long application, so you can get a view of how it works on the long application. If it'll let me pull it up, let me see. There we go. So here is our long application. what you're going to see on the long application in the producer's report, I'm going to scroll down here. There's going to be a section on smooth sailing in the producer's report, section 3. And it's going to ask you these questions. Has your applicant, is their age nearest birthday 50 to 69? And, you know, if they are, let's say they're 55. The amount of coverage is less than or equal to pending and enforced with Pacific Life. And then lastly, has an intending physician statement with a physical and blood work within the last 18 months. So if you can answer all 3 of those yes, you would click it here, and that would trigger us when we receive the application in-house to actually process this case as a smooth sailing case. And if any paramedical exam was set up to be ordered, we went through this, we'd find that out, and we would cancel that, so that would not proceed, and we would just go after the APS, assuming the client qualifies for smooth sailing based on the information. Go back to our PowerPoint. So now, either way you go, so if you're going either the drop ticket method or the long application method, we will do a phone interview with the consumer, with your client, to ascertain if they qualify for smooth sailing. If you're doing the electronic ticket, that tool, if you're utilizing that tool, what's going to happen is Exam One is our fulfillment vendor. When they call the client, they're going to ask their normal questions to complete the Part 1, but they're also going to ask some additional questions around smooth sailing. And what you're seeing on this page here is the additional questions that Exam One's going to ask the client to see if they qualify for smooth sailing. So the first question they're going to ask is, when was your last comprehensive physical where height and weight and blood pressure was done? And the reason we say comprehensive physical, we want to make sure the client understands we're not asking when was the last time you went to the doctor for a cold. We want to make sure that their APS has all the information that we're going to need to underwrite the case. So that's why we're saying it is a comprehensive physical that it take place. And if a client says, yeah, my last comprehensive physical was, 10 months ago, okay, that means they could qualify. Then they're going to go on and they're going to ask, did the physical include a blood draw or blood test? Were they being tested for cholesterol or glucose, anything like that? Again, if they say yes, it's going to lead down to these other 2 questions here. Who conducted this physical and blood test? Because we want to find out who the doctor is that we need to go to get the client's APS from, and what's their name and address. Now, if it was a long application, it's going to be a much shorter conversation because they're not asking all the questions we need to fulfill the Part 1 on the application. So if you submitted a long application under smooth sailing, we're still going to have a smooth sailing phone interview with the consumer, but it'll be a much shorter conversation, and it's just going to primarily focus on these types of questions to find out, hey, do you qualify for smooth sailing, and can we proceed down the path that way? So I want to spend the last part of our conversation. If you have no questions around smooth sailing, just go ahead and if you have some, go ahead and put them in the chat box. Yes.
Hey, Carlin, this is Ed. How you doing? Yeah, I just wanted to say this is a really nice program because it goes up to age 69. It's something that's kind of unique out there, and it's something that we're starting to see more and more of. And so I just want to say that it is something that it is coming into play a lot more often, and it's really nice having the fact that they can go after all that information electronically. So it is something we're seeing a lot of.
Yeah, it can be touchless from beginning to end, and that's the thing a lot of folks are looking for right now. I mean, a lot of people that maybe have put off getting insurance are now thinking, okay, maybe I definitely need it. Now it's top of mind, let's say. So they're saying I need to get some life insurance, but I don't want to risk exposure. So what can I do to get some life insurance without being exposed to other people? So this is a great platform for that. And to Ed's point, I'm not aware of any other carrier that has an accelerated program like this or a Fluidless program like this that goes up to age 69. You can see from our age limits, 50 to 69, we don't have a program for people under 50. And the reason this program works for that age group typically is what you see is folks between 50 and 69 traditionally usually are going to their doctor for a reason on a yearly basis. Like I said, maybe they have high blood pressure, maybe they have cholesterol, maybe they're diabetic. So there's a reason they were having to go to their doctor on a regular basis, and they are getting blood work drawn. So they would qualify and they wouldn't get kicked out. Whereas someone younger, let's say a 30-year-old, more than likely isn't going to see their doctor on a regular basis, and we're not going to be able to get the information that we need out of that APS. And I do have a question. The question is, can I tell the difference between California and Virginia Pacific Life? Okay, and does this program apply to California? This program does not apply to California. So good question. So Pacific Life, we're all one company, but we do have 2 different divisions and 2 different product sets. So when you think of California, you primarily think of cash accumulation products. And when you think of the Virginia Pacific Life, you think of death benefit protection products. So for California, the number one selling product is that IUL product that they have there, which is a wonderful product. And then for us, we sell PL Promise Term. So on the Virginia side, we're selling the PL Promise product series, which is our term insurance as well as our GUL product. And what I'm going to talk about right now is our conversion product. It is a conversion-only product, but if you sell a PL Promise Term product, the only way to get to this conversion product is selling a PL Promise Term. So I want to spend a little bit of time talking about the conversion product, but there are different programs. So let's say you applied for the California product for something with a client, and then you were interested in adding additional term coverage to the client, and you were interested in doing the PL Promise product. The underwriting is not guaranteed to be the same. We do use Swiss Re as our background underwriting model, but it is different underwriting that's applied. So California might have a program that we don't utilize, and just like we have the smooth sailing product that they don't utilize. So there are two distinct platforms, even though it's one company, it's two distinct platforms, and we distribute the products differently in each of those platforms. Good question. So I don't know if any of you guys and gals that are on the line, if you've ever sold Genworth product. Genworth prior to 2016 was a very top seller of term insurance. So that product that Genworth sold, if you go back in time, was actually the first Colony term product. It was called Colony Term. So when Pacific Life wanted to get into this marketplace and wanted to open up term sales and get into brokerage, what they did is they actually acquired that product from Genworth. They didn't acquire the book of business. They just acquired the product chassis. So when I'm talking about PL Promise Term, I'm talking about the old Colony Term product that's been repriced and rebranded. So just if you've ever sold that product, keep that in mind. That is the same product that we're looking at. We have made enhancements to it. Obviously, we actually have a 25-year duration that Genworth never had. So it's your normal 10-year, 15-year, 20, 25-year, and 30-year durations. Our age range focus for that product is ages 30 to 70. You're going to see us typically be competitive out to at least a table 6 because we do have a substandard pricing advantage. But I will give you a caveat. Right now, today, we're only looking at cases out to table 4 just because of what's going on with COVID-19 and our reinsurance agreement. So we're only looking at cases out to table 4 for the term product and up to age 71. When I was talking about the smooth sailing product, I forgot to mention this. That is available out to table 4 today because of COVID-19. Once we're out of this stage, it's actually available for all underwriting classes once we're actually opening back up to tables outside of a table 4. But I just want to point that out because that's also something that's very different from the other carriers' platforms. Most of those restrict, to standard usually. They don't want you to go to a table rating case. So I just want to point that out. So if you sell a PL Promise term product, you're able to convert to the PL Promise Conversion UL. It is a no-lapse guarantee product, and we made it competitively priced. We wanted to learn from past mistakes when we looked at other carriers out there that were primarily term-focused. They really didn't have a very good conversion solution for their clients. So we wanted to make sure we came up with something that was different and learn from past mistakes. And so that's what we did with this product. And what you'll see is we're actually competitively priced, even though we're a conversion-only policy, we're actually competitively priced against other carriers' new sale GUL products. I just saw a question about, was the product available in New York? Unfortunately, we do not have any products approved in the state of New York today. This product also does have a return of premium feature built into the product. So let's say you have a consumer and they want to convert their PL Promise product, but they really only need to keep it for 15 years. So let's say they converted, they kept it for 15 years. At the end of the year 15, they choose to surrender the policy. They can get up to 50% of their premiums back or 35% of the death benefit, whichever is the smaller of those two. If they were to keep it 20 years, they can get up to 75% of their premiums back or 35% of the policy's death benefit. And lastly, if they keep it for 25 years and then choose to surrender, they can get up to 100% of their premiums back or, again, 35% of the death benefit, whichever is the smaller of those two. Now, the way this works is a minimum guarantee policy. You can dial it down to age 85 or take it out to 121. I will warn you, to get the return of premium feature, you need to at least guarantee it to age 100. So if you don't guarantee it to age 100, let's say you dial it down to age 85, then the return of premium feature is not going to be a part of the product. So just keep that in the back of your mind. We do allow partial conversions with this policy. So let's say you sold a $500,000 term. The client comes to you and they say, I want to convert, 250,000 of it. They could come and convert 250,000 and keep the remaining 250 in the term. And maybe 2 years later, they come back and say, you know what, I want to convert another 50,000. They can do up to 2 partial conversions on the policy. The minimum face amount is 50,000 on those conversions because that's the minimum face amount for the term policy. And something I really want to focus on with this product that's very different in the industry when it comes to conversion products, especially conversion-only policies. When we developed this policy, we wanted to make it a win for you as the distributor, a win for your client, as well as a win for us as the carrier. So we wanted to make a different approach. And so what we're doing is an early, mid, and late term approach to conversions. I'm going to show you what that looks like on the next page. But that approach allows us to give you up to 150% of normal compensation on conversions. So it gives a nice incentive to you to talk about conversions, to have that conversation, is it gives you that bonus. And also something that we're doing very differently is in the 3rd policy year of every one of our PL Promise terms that are sold, we're going to actively market to the consumer for you to say, go back to your agent and have a conversation about conversions, talk about conversions. A lot of carriers out there that are primarily term focused kind of hesitate to have that conversation around conversions. So we wanted to do something very different with our product. So this slide shows you how our early, mid, and late term approach to conversion works. And I'm just going to walk you through a PL Promise term 10-year example. So let's say you sold the 10-year term to one of your clients. The consumer comes to you in year 4 of the policy, has a conversation, or you come to them. Let's say you go to them. You have the conversation about conversions, and they decide to convert the policy. We'll pay you as the agent on the policy up to 150% of normal compensation. So we built this bonus into the pricing that we can give you a bonus if you do an early term conversion. Because an early term conversion is a win for us as a carrier because that's where we experience our best mortality with conversions. Let's say that conversation didn't happen. And in year 8, you realize you haven't had a conversation with the client. You call them up, you say, let's talk about conversions. So in year 8, you have the conversation. Client decides to convert. So years 5 through 8 for a 10-year term policy are considered a mid-term conversion. So if you convert it in year 8, we're going to pay you 100% of normal compensation. So whatever your grid is what you're going to get at that point. You're going to get that exact amount. You'll lose that bonus that you would have had if you converted in the early years. The consumer is still going to get our most competitive pricing. However, they're going to be 4 years older. So it's going to cost them a little bit more just because they're 4 years older. Now let's move to that last column. So let's say the conversation didn't happen. The consumer calls you and says, I've got to convert this policy in year 10. What usually is driving that conversation in the end of a guarantee period for a term policy? Well, typically, maybe the client had some type of health change, or maybe they're uninsurable at this point. So we as a carrier, this is where we experience our worst mortality, is in these late term conversions. So what's going to happen here is we're actually going to cut your compensation in half. You'll get 50% of your normal compensation, and the consumer is going to actually pay a higher premium, not just because they're older, but because the pricing is different. And when you look at this product in, let's say, WinFlex, you'll see early pricing and you'll see late pricing. The good news for you guys is our policies have only been on the books. They started in November of 2016. So not a one of them is over 3 years old at this point. So every single one of the policies that are on the books today are in that early conversion bucket. So you would qualify for that, that bonus. Now, if your client came to us directly and didn't come to you and converted, we would still pay you the commissions on the policy. So you don't have to worry about that if they were to come directly to us. We'll still pay you the commission. I want to make sure I did see a chat box question. I want to make sure I answered it. Yes, I did. Okay. So just wanted to give you a view of our sales team. I'm there in the middle. I support you guys, and I'm here to help you in any which way that I can. That is my cell phone number. And normally what I would say is I travel a lot because you can see how large my territory is. But right now I haven't traveled for months. So if you need me, just give me a call. I'll be glad to help you out any way that I can. And with that, I'm going to hand it back over to Ed.
Yeah, thanks, Carlin. Yeah, so it is a very interesting opportunity. I mean, not a lot of carriers have competitive, when they have conversion-only products. I mean, just to have that refund feature is something that's unique as well. You know, a lot of carriers don't put that on conversion products. So it is an interesting product. It's an interesting idea. And I like the fact, too, with the fact that you guys are actually marketing the conversion, which gives people the opportunity to have that conversation. So if anyone has any additional questions, if you want to write them in the chat box, or if you want to get back to me at a separate time, we can also do a call with Carlin if we want to dig deeper into the program, or if we have any additional questions. Other than that, I can turn it over to Kathy.
We've got another question, Ed, which is, and this is for Carlin. Can you discuss the conversion product pricing versus other carriers who are applying for current coverage with new meds?
Yes, and I'll actually show you, let me pull up the presentation. I do have a slide. This is not in this presentation, but I'll pull it up for you. That shows you the pricing, because that's a good question. So here you see, this is an example of our product pricing, the conversion pricing. So in this example, you're looking at a male age 60, standard risk, $500,000 a death benefit, and it's a full pay scenario. On the left-hand side, you're going to be guaranteeing the policy to age 85. On the right-hand side, you're guaranteeing it to age 100. I did mention this earlier, but both our GULs, our conversion as well as our new sell GUL products, are more attractive with the shorter the guarantee. So if you dial it down, you're going to have better pricing every single time. So on the left-hand side, at the guarantee to age 85, the lighter blue bars, that represents our conversion pricing for the early as well as the late. The 3 dark blue bars in the middle are other carriers' policies, other carriers' GUL policies that if a client applied for, let's say, the Pru Life one, they'd have to be fully underwritten to qualify for that policy. And then the last 2 bars, the dark blue, longer bars on the page there are other carriers' conversion-only solutions that kind of match up with ours. What you're going to see here is that we're very competitive even against the carriers that the client would have to be fully underwritten. And we're substantially more competitive than the carriers that have these conversion-only solutions like ours. Now, if you go to the right-hand side of the page, the guaranteed age 100, I'll point out on this example, the client's going to get the return of premium feature in the guaranteed age 100. In the guaranteed age 85, they're not getting that return of premium feature. Again, just keep that in the back of your mind. Same scenario, those light blue bars represent Pacific Life, the early as well as the late term conversion period. The middle bars are the new sell carriers, and the last 2 bars are the other carriers conversion only. Our pricing is slightly more expensive here, but we're still way more competitive than the other conversion policies and slightly more competitive than the carriers that they would have to be fully underwritten to qualify for.
Carlin, when you say that too, also this slide's dated March 4th, and a lot of carriers have repriced since then. So some of those numbers come more in line with what you're looking at.
Yes, you're exactly right. Due to the interest rate market, a lot of carriers repriced or put ceilings on their GUL sales. So, for example, I'm glad you brought that up, Ed, because our GUL is capped right now, not the conversion policy, but our new sell product is capped right now at 2.5, and we did have to do a reprice on May 4th due to the interest rate market that we're living in.
Yeah, but it's nice to have a nice conversion option available. So that's good.
Is there anything else you guys want me to talk to?
No, I think we're good. If you want to wrap it up, Kathy,
Okay.
I think we have all the questions. Again, if anyone wants to reach out to me, I can try to address any further questions, or if you want to have a call with Carlin, we can try to set that up. Thank you, guys.
Thank you.
Yeah, thank you, Carlin. Yeah, thank you, Carlin. Thank you, Ed. Just one other thing. Ed, you had mentioned that this slide was from March 4th. It's from March 4th of 2019. So it's
way out of date. It's
yeah, so it's way out of date. Exactly. So I just wanted to point that out. In any event, Carlin, thank you so much. Ed Stark, my apologies at the outset. I failed to turn it over to you, and that was an oversight on my part. So my apologies.
No worries. No worries.
Thank you, everyone, for participating. I want to inform everybody about next week. And the rest of this week. We are not going to be having a webinar this Friday, so it was just Monday. And today, Friday, we're going to pass, and we're going to start again next Monday. We've got a very interesting week next Monday and Wednesday. Monday, we're going to be featuring David McKnight, who is the best-selling author and highly regarded and sought-after financial speaker. He's the author of The Power of Zero. We're going to be hosting him for an hour on Monday from 12 to 1. And the invitations are going to be going out this afternoon. So please register for that. We're very excited to be hosting David, and I know that that's going to be a very informative hour. And then on Wednesday, we're going to be following up, talking about the power of zero with another call about the Annexus products from Nationwide and Securian. So we're going to do another review of them. We've had a lot of questions about these products and the opportunities, so we thought it best if we focus another hour on both of them. It's not going to be an introductory call. We're going to go over both of those products again and dig a little deeper. So we hope you'll be able to join us as well. I hope everybody has a great week. If Agency One can do anything for you, please reach out to Gonzalo, myself, Ed Lesher, Ed Stark, Dennis Bartos, and the rest of your team at Agency One. Carlin, I want to thank you again. And with that, we're going to conclude. Thank you so much,
Thank you so
everyone.
much.
Bye.